You've probably heard whispers, or maybe loud warnings, that major Canadian banks are pulling back from the housing market. There's less spending, there's more restrictive appraisals, developers are struggling to get financing for projects they already have underway, and homebuyers are getting unexpected denials even with decent credit. So what's really going on? Why are the very institutions that fueled Canada's decades-long real estate boom now pumping the brakes? In this episode, we're going to talk about why the banks are doing this, what typically comes next, and how you can actually protect yourself from this structural shift. Let's begin with one of the most overlooked reasons for this change: Canada's crushing tax and debt burden. Canadian households are some of the most indebted in the G7, and combined with elevated taxes, both personal and corporate, there's less disposable income, less room for consumer risk, and far less incentive for institutional capital to remain in Canada. I mean, just since February this year, Canada has lost over $84 billion in capital to US markets as investors are chasing higher yields and honestly just better performing economies with better GDP. Why is this important? Because banks don't just assess mortgage applications, they assess the entire economic market, the entire environment. And right now, Canada looks like a much riskier bet than it did. Banks see a consumer base increasingly over-leveraged. They are extremely heavily taxed and income constrained as a result of that. Combine that with government policy, uncertainty, rising defaults, stagnant wages, and you've got the perfect storm for capital flight. Just remember, investment loves consistency and predictability, and neither of those things are present in our market. Let's dig a little deeper. Canada's tax to GDP ratio is among the highest in the developed world. The average Canadian household now pays over 45% of their income just straight to taxes, more than they spend on housing, food, and clothing combined. In fact, I think a lot of people wouldn't be so upset about this if our tax dollars were put to good use. But instead, a lot of those tax dollars leave the country. They get wasted on all kinds of government expenditures. And there's just very little accountability for overspending. I mean, right now, we don't even have a budget. So no wonder banks are scared. Household to debt income sits at 180%, meaning for every $1 of disposable income, Canadians owe $1.80. And Canada hasn't had major tax reform since 1988. That's nearly 4 decades of outdated tax policy in a modern, mobile, high-debt economy. This outdated system means fewer incentives for investment. The US has just got way more. We have reduced economic flexibility and worsening inequality. Combined with rising debt, the system is strangling Canadian households and driving investment out of the country. This is why banks are pulling back. They see the writing on the wall, much like I talked about. I want to get into something that really kind of angers me about this. The banks, for whatever reason, profit-related reasons, they fueled overextended borrowers. They fueled the soaring defaults. They fueled limited wage growth, and honestly, they've contributed to dwindling consumer confidence. They had a hand in all of this. And what's more is this next issue, blanket appraisals, are contributing to the problem. So what are they? Because I'm sure you've heard a lot of it. One tactic that the banks are using right now is a blanket appraisal. Instead of assessing the value of a property on a case-by-case basis, they assign an average price to all homes in a development or in a neighborhood. This isn't fair, but it helps banks limit their own risk. It also kills any kind of deal-making. Imagine a buyer paying a premium, as an example, for a custom layout or a fabulous view. But the bank says, sorry, it's only worth what the average is going for. It's just simply not true. And as a result, projects end up getting delayed, sales end up collapsing, and it drives this chilling effect into the entire market. But this isn't the first time this has happened. Let's look at historical parallels, as I love to do. So in 1981, 1982, during the Volcker era rate hikes, Canadian banks limited mortgage issuance altogether. Housing starts fell by 50%, and credit began to dry up, a little similar to what we're seeing today. Fast forward to the 2008-2009 global financial crisis, and you have a CMHC, that had to backstop billions in mortgage risk. Banks drastically cut their exposure and some stopped lending altogether. By 2018 and 2019, the B20 stress test came in and cooled the market. This cut bank lending, particularly in high-cost urban areas, though perhaps this was a pretty good idea as it front-ran the risk for banks in a property market that had ever-increasing values. What's more is in the 1990s, we had the commercial real estate crash. After overbuilding in the 80s, banks pulled commercial lending across Canada. Vacancy rates soared and values collapsed. Many projects were sold at a loss or taken over by the lenders completely. In each case, the sequence is pretty clear. Banks retreat, credit will dry up, and prices will fall. So, interestingly, where do banks go when they retreat from real estate? Well, they go back to the government. They go to government bonds, safe and predictable returns. They do exactly what I've mentioned. They go to the US equities and treasuries. Stronger growth, higher levels of liquidity, that's what banks like. Alternative investments, they look at infrastructure and energy projects and private equity. They do shadow lending and stuff like that because it creates higher returns and there's better collateral. Remember, banks, they're just not emotional. They follow the money. If housing is too risky, they move somewhere else. And this is why I want you to pay attention. So, what do we take from all of this? Right? What's the resolution? The banks leaving isn't just about risk management. It's a referendum on Canada's entire financial ecosystem. High taxation, record debt, weak productivity, stagnant wage growth, and now capital flight. $84 billion in the last 4 months. But every reset creates new rules, and with that comes some opportunity for those who understand the signals. So let's get specific. If you're a buyer, this is the moment to try and find a distressed seller. I talked about this before in a previous video, but properties with long days on market, canceled deals, or developers even offering incentives, 25% off in some instances, but you need liquidity and strong credit. So if you've been sitting on the sidelines and you've built those two things, I would start your foray into this mess because you could find yourself a pretty good opportunity if you're prepared to take on some of the risk. If you're an investor, focus on cash flow. Appreciation is no longer guaranteed, especially in the Canadian market. Look for multifamily units, short-term rental pivots in strong markets or stronger markets, and properties with value-add opportunities. Prioritize yield over speculation. Find the signal. If you're a developer, get creative. You have to look at alternative lending, joint ventures, equity partners, even potentially some foreign capital if it's been in the country long enough. Institutional lending is very weak right now, and flexibility in your realm equals survival. If you're a homeowner, watch the market fundamentals. Look at the data. Never mind what happened in the last few years. Whatever you do, don't panic sell. If you can hold, this phase will pass. It will. But if you must sell, you got to price it realistically and understand what the appraiser is looking for. What's more is you need to price ahead of the curve. If you price behind the curve, you will catch a falling knife. You will continue to lower the price only to sell at the bottom. So get aggressive early, make that hard decision up front, and save yourself a bunch of money. Let's look at the overall bigger picture. The shift is highlighting something much deeper. Canada needs economic tax reform, productivity reform, just general economic reform. Until we modernize, capital will continue to flee. The middle class will continue to get squeezed and pay for everything. And real estate, once Canada's surest bet, will remain volatile. This is a huge wake-up call for us, not just for buyers and sellers, but primarily for policymakers. Because if banks are walking away from our most important asset class, it's not just a financial problem. This is systemic.